One of the biggest reasons people delay buying a home isn't income, it's misinformation. Many people believe that if they don't put down 20%, they'll be punished with mortgage insurance forever. But that's not how it actually works. Yes, I'm saying that that is not true. You don't always need 20% down. So in this video, I'm going to break down the biggest down payment myth so you can actually know what's real and what's working on today's market. And I want to help you understand what matters so you can make a wise and smart decision. Just know that a typical first-time buyer had a down payment in 2025, had a down payment of 10%, not 20%. And several major loan programs allow for much less for qualified buyers. So let's talk real estate. Before we jump in, I want to say thank you so much to everyone who has subscribed. At the time of recording this video, we are over 300 subscribers. To some, that's not a lot. To me, I appreciate so much each and every one of you that has subscribed so far. I appreciate it. Each one of you matters. The thousands will come, sure, but now you, I appreciate. If you're new to this channel, just know that we're here for home buyers, for investors, for homeowners, for people that are thinking about relocating, people that want to talk about real estate, and here we just give practical, honest, and just clear advice. So please, if you're one of those, I appreciate if you subscribe, if you like, if you share, if you comment. We kind of have to ask this question. We have to ask you that because it does help us, but hopefully it's not only helping us, hopefully it's helping us because we're providing you content that you want to know about. It's stuff that you're learning about. So please subscribe, share it, and if you have done so already, thank you. This topic matters right now because buyers are not only dealing with home prices and high interest rates, they're also dealing with mental barriers. And this needs to be broken. This needs to be broken. And one of the biggest barriers is this idea that if you don't have a massive down payment, you should not even try. See, that mindset keeps people renting longer, at least definitely longer than they plan or they should. It keeps families from having a real conversation with a lender. It keeps investors from analyzing opportunities. And it also keeps relocating buyers thinking the market is out of reach or is not something that they can achieve. And the truth is this, the question is not just how much money can I put down? The better question is, what is the smartest way for me to structure this particular purchase based on my goals, on my income, on my reserve, and my monthly payment comfort? That's what you really need to be asking. Because, see, a strong real estate decision is not about winning a myth. It's about choosing the right strategy. So let's bust some myth. Myth number one, if I don't put down 20%, I'll pay mortgage insurance forever. This is one of the biggest fears buyers have. They think, if I don't put 20% down, I'm going to be stuck paying, mortgage or insurance mortgage forever. But that's not always, how it works. With conventional loans, PMI, which is the private mortgage insurance that you hear a lot about, it can often be removed once the loan reaches 20% equity. But what people a lot of times don't remember is this, that this can happen in several ways. It can happen because the normal loan amortization, in other words, simply paying down the loan over time gets you to 20%. Or it could happen because your home appreciated with a combined refinance. You appreciate, you refinance, you can get it 20%. It also could happen because you can request the PMI to be removed after a new appraisal shows that the equity in the house has increased. So in many cases, PMI is temporary, not permanent. So let me walk you through an example. Imagine a buyer purchases a home for $500,000. They put down 5% down, which is $25,000, leaving a loan of about $475,000. Now, let's say a few years have passed and the home appreciates in value, so now the home is worth $575,000. At this point, the homeowner may already have 20% in equity between the down payment, the principal they have paid, and the appreciation of the home. If the lender confirms that the equity through an appraisal, the borrower may be able to request the removal of the PMI, even though they didn't start with 20% down. And that changes the math significantly. Because many people are waiting years to save 20% for a down payment, when in reality, PMI might only cost you a few $100s per month, and that's only temporary, while at the exact same time you build in equity. And that's an important distinction. Now, FHA loans work a little bit different. FHA loan use something called the mortgage insurance premium, or MIP. For many FHA loans today, if the buyer puts less than 10% down, the mortgage insurance usually stays for the life of the loan. That's true. If the buyer puts 10% or more as a down payment, the mortgage insurance typically lasts about 11 years. However, many people who choose to get an FHA loan to become a homeowner, later they simply decide to refinance, and they refinance into a conventional loan once they know they have enough equity which can remove the mortgage insurance at that point. So the real takeaway is this: mortgage insurance is not automatically forever. It depends on the loan type, how much equity you built, and the strategy you use after buying the home. And understanding, having just that understanding can make a difference. It can completely change how somebody thinks about saving for a down payment. Myth number 2, you need 20% down to buy a home. This is probably the biggest myth of all of them. Now, let me be fair. Putting 20% down can be powerful, and I did another video about that as well. It can reduce your loan amount, it can lower your monthly payment, and it can help avoid, as I said, number 1, your private mortgage insurance on many conventional loans. But needing 20% down, that is a different conversation. FHA loans can allow qualified buyers to purchase with as little as 3.5% down. Fannie Mae's Home Ready program can go as low as 3% for eligible borrowers. VA loans typically require no down payment, and USDA guarantee loans can also offer no money down financing in eligible areas for qualified borrowers. So let's use simple math. If a loan is $500,000, 20% down is $100,000. 10% down is $50,000. 5% is $25,000. 3.5 is $17,500. 3% is $15,000. That is a completely different conversation that sometimes could help people achieve home ownership sooner. So for many people, the jump thinking from the need of $100,000 to realizing they may be able to start the process with far less is huge. Not because it means every loan is right for every person, but because it moves them from hopelessness to being informed. Myth number 3, a lower down payment is always a bad financial move. It's not always. Sometimes people hear, put the least down possible, and they treat that like the smartest move in every situation. That is also a mistake. A lower down payment may help you buy sooner, but it can also mean a higher monthly payments. It can mean mortgage insurance in some cases. It could also mean you have less equity on day one, and it also could mean less cushion if the unexpected happens. So this is where wisdom comes in. let's say we have two buyers and they're both looking for a home that costs $500,000. Buyer A puts 20% down and keeps the monthly payment lower. Buyer B puts 5% down and keeps more cash in savings. Tell me, which buyer made the best decision? Go ahead, tell me. Put it in the chat. I'll wait.
A few moments later.
The right answer is, it depends. If buyer B would have empty every account just to hit 20%, that may not be wise. Owning a home is not reserves. Owning a home with no reserves can become stressful very quickly. One repair, one job shift, one emergency, and the pressure goes up really, really fast. The stress goes up really, really fast. And you know me, I like protecting my sanity and your sanity too. Don't be stressed, not if you can help it. So it depends. You see, sometimes a slightly smaller down payment with stronger reserves is actually the more stable move. This is one of those areas where I really want viewers to think like owners, or actually not to think like owners, think more like investors. And that's really important because you are buying a piece of real estate, not just, you're not just a loan borrower. You are an investor. You're investing in that piece of property. That's important. $500,000, that's a lot of money. And here in South Florida, houses could go for so much more, as you know. Myth number 4. The down payment is the only cash you need. This one catches people just off guard all the time because they think about the down payment, they don't know about everything else. That your down payment is only one part of your upfront cost. The Consumer Financial Protection Bureau, or CFPB, says that closing costs typically range from 2% to 5% of the purchase price, and that is not including your down payment. So let's keep using the exact same $500,000 home example that I used before. If closing costs land between 2 and 5%, that could mean anything, anywhere from another $10,000 to $25,000 in addition to your down payment. Of course, this depends on the loan, the property type, taxes, insurance, prepaid items, lender fees, and a bunch of other things. So that's why it's a range. So that means that a buyer planning for a 3.5% down payment on $500,000, they might focus on the $17,500 that they need for a down payment, but you still need to think about the additional costs that I just mentioned, and that is also needed for closing. So, this is why buyers feel blindsided when they're not educated early, because they think the whole game is save the down payment, when the real game is understand the full cash picture. Myth number 5, if you get help with the down payment, something must be wrong. And no, not at all. There are legitimate ways buyers may receive help. In some cases, gift from family, that's allowed. So as long as they meet the loan program's rules and documentation requirements. Make sure you educate yourself before receiving a gift. The CFPB, they know that certain loans allow gift for down payments, but buyers need to confirm what documentation is required with the loan before they choose. So not all gifts are created equal, I guess. So just be aware. There are also assistance programs that may help with the down payment or closing costs. Here in Florida, for example, the Hometown Heroes program offers eligible borrowers assistance through a 0% deferred second mortgage through eligibility, occupational rules, and funding and all that stuff matters. So, but it's there. It might be available. That does not mean every program is right, and it does not mean free money with no strings attached. Read the fine line. It means you need to understand the structure. Some assistance is forgivable after a certain period. Some is deferred. Some must be prepaid when you sell, refinance, or pay it off, pay off your first mortgage. So the issue is not whether help is good or bad. The issue is whether you understand the terms. Let me interrupt your video just for a moment, just to say, if you are considering investing in real estate, whether you're buying a property or maybe renting the one you already own, or maybe converting the house you live in into a rental place, or if you're thinking of anything in real estate and that you need a realtor, I'll be happy to be that connection for you. Call me. My information is in the comments below, also is in the description as well. I would love to have a strategic session with you just to brainstorm and to see where you're at and how we could work together, achieve the dream of financial freedom that maybe you're thinking about. So thank you for the moment. If you have not done so, please subscribe to the channel. I would love to be part of your world as we continue to impart information to you. Thank you, and let's get back to the video. Myth number 6, if I can't afford the monthly payment, my down payment strategy doesn't matter. It absolutely matters, because your down payment affects more than your monthly payments, right? Your down payment may impact your loan options. Yes, it does. The amount affects that. It can impact your mortgage insurance. Yeah, it can impact your debt to income flexibility, your cash reserves after closing, your stress level after moving, your ability to handle repairs, furnitures, and life. Here's a real life example. A buyer says, I can't afford the payments. Okay, but what happens after closing if they also need moving costs? If they need a washer dryer combination, if they need window treatments, if they need first repairs, if they need HOA application fees, if they need insurance adjustments, a few $1,000s for things nobody told them about can throw your whole game off. That is why smart buyers do not just ask, can I get approved? They ask, will I still be financially stable 60 days after closing? That is a much better question, and you have to be financially prepared to answer it before you become a homeowner. So it's not just the down payment. Myth number 7, zero down means zero cost. This is a big one. A zero down loan does not automatically mean zero out of pocket. With VA and USDA, qualified borrowers may have no required down payment, but they can still be closing costs. They could still be prepaid items, inspections, appraisals, moving costs, and just other transactions I need to be aware of as well. So the CFPB's general closing cost guidance still matters here. And VA also notes that borrowers may face lender fees and other closing expenses. So again, you do need money to buy a house, or any investment property for that matter. So that is why buyers should never hear zero down and assume I need no cash. Sometimes seller concessions can help, sometimes lender credits can help, sometimes assistance can help, but it has to be structured correctly. This is why words matter in real estate. Zero down is about financing structure. Cash to close is about what you actually need to bring to the table. Those are not always the same numbers, and that's part of the conversation that you have to have as you get ready to make your purchase. Myth number 8, bigger down payment always means the best loan. Not true. Not necessarily. A bigger down payment can strengthen a file. That is true. But the best loan is not just the one with the biggest down payment. It is the one that fits your full situation. For example, see, maybe one buyer benefits from a conventional financing with 5% down, but maybe another buyer is served better by FHA because of the credit profile. Maybe another qualifies for BA and wants to preserve the cash. Maybe another should wait and improve their whole file first. In other words, the strongest buyers, are not always the ones with the biggest down payment. Often, they are the ones with the best overall profile, stable income, manageable debts, solid documentation, realistic expectations, and cash reserves. That is a different kind of strength. Myth number 9, waiting until I have more down payment always saves me money. Sometimes, yes, sometimes, no. This is where the conversation gets more strategic. Waiting can help if you need to improve your finances, if you need a stronger reserve position. Waiting can help if you need to lower your debt. And also could help if you need time to build credit or job history. But waiting can also cause if home prices keep rising in your targeted area, if rents continue draining your savings, if you miss a program that could help today that might not be around tomorrow, if you keep chasing a perfect scenario that never arrives. See, there's no universal answer here. Saving a larger down payment can lower your payment, but if prices rise while you wait, the home itself may become more expensive. And if rates move, the math changes again. So the goal is not to force a purchase too soon, but be careful with too late. The goal is to compare the cost of waiting against the cost of buying now. That is the kind of conversation serious buyers need to have with an agent and lender together. And myth number 10, saving a bigger down payment is always the fastest way to become a homeowner. See, this myth, it quietly just delays thousands of buyers every year. People tell themselves, once I save $100,000, then I'll buy. But the market doesn't really wait. While someone is saving a bigger down payment, home prices may increase, rent may increase, interest rates may move. The target home price may also be higher later. So let's say someone wants a $500,000 home. I've been using that number all day, so let's keep with that. And they decide to wait until they have $100,000 saved for that, 20%. But if the prices rise 5% per year, that means year 1, that's $525,000. Year 2, that's $551,000. Now the down payment is no longer $100,000. Now it's $110,000. They ran forward, but the goalposts move. This doesn't mean waiting is always strong. Sometimes waiting is wise, but waiting only for the sake of hitting 20% may not always be the best strategy. So the real question becomes, is the cost of waiting higher than the cost of buying sooner? That's a much more intelligent conversation that, again, you need to have with your realtor. Call me to have the conversation, or with your banker. It's important, so you know exactly when it might be the best time for you to jump in and make the transaction happen, buy the home that you're looking for, become a homeowner or an investor, whatever the case might be. Have the conversation. Don't think about your cousin and what they did, or your neighbors and what they did. Every single person is different. Every single person has a different scenario. Every person has a different goalpost. Every single person's budget is different. So don't compare. Don't listen to whatever everybody else said. Sit down with a professional that could guide you in your current situation right now and find out what's best for you. So if you're talking to a realtor or a real estate agent, and they're pushing you to buy now or to sell, whatever the case might be, without understanding your full picture, do yourself a favor, find yourself somebody else. I don't care if they're your friend, your cousin, your auntie. Find yourself somebody else that truly look at your numbers and understand your situation and has your best interest at heart. Not their own, not their commission, not anything else. And the honest person will tell you you're in a really good financial position right now to buy. Do it. The market is showing these signs. Do it. Or maybe you should wait a little bit more because you don't want to jump into your house and 6 months later lose it, a year later lose it because your finances are not strong enough. Or create a strategy for work, for saving, for getting the family involved, the wife, the husband, the kids, spouse, whatever the case might be. Get them involved in achieving these goals together. So with that in mind, let's just go deeper. Let's talk about that some. And this is important because this is when a lot of people make just costly mistakes. A lot of buyers focus on getting in, but they do not think enough about what happens after they get in. And that is where the down payment strategy becomes very, very important. It's not just a one-time thought or one amount. It's a strategy. It needs to be part of your strategy. For example, a buyer who puts most of their money down may get a lower payment, but if they have no reserves left, they could be financially fragile. Another buyer may put less down, but keeps reserves and accept a higher payment, but that only works if the payment is still comfortably affordable for them. Another buyer, may receive assistance, but they do not understand the repayment trigger. They may be shocked later, years later, whenever the document says, when they try to refinance or they try to sell, they may be shocked. So, maybe another buyer may keep waiting for the perfect 20% moment while home prices, insurance costs, or rent keeps changing around them. So the deeper lesson is this: down payment is not just a number. It has to be part of your larger strategy. It's a larger risk. It's a management decision. So you're balancing monthly affordability, you're balancing liquidity. You have to think about the stress tolerance that you have. You have to think about your future plans, market conditions, financing options. This is what good advice really, or this is where I should say good advice really matter, really makes sense. Not because someone needs to sell your house, but because someone really needs you to think clearly about your financial structure. There's a principle here that goes beyond real estate. Jesus said in Luke 14:28, which of you, desiring to build a tower, does not first sit down and count the cost? That is not fear, that is wisdom. And I think that applies beautifully to home ownership. Do not let fear keep you out, but do not let pressure push you into buying blindly either. Count your costs, understand the terms, ask the question, get counsel, and then move with confidence. That's all. And that is a better way to buy. And I know I say a lot of terms, I say a lot of things. This is very possible. Many people do it every day. You could do it too. Just be educated in the process. So let me leave you with a few takeaways. Number one, you do not always need 20% down to buy a home. Many buyers purchase with less, depending on the loan and their qualification. Number two, down payment is only part of the cash picture. You also need to understand closing costs, prepaids, and reserves. CFPB says closing costs typically run about 2 to 5% of the purchase price. Number 3, a lower down payment is not automatically bad, and a higher down payment is not automatically wise. The right move depends on your full financial picture. Number 4, if help is available through gift funds or assistance programs, do not dismiss it. Just make sure you understand the terms and long-term implications. And number 5, the smartest buyers are not just trying to close, they're trying to close well, with clarity, with confidence, with stability, with a path forward, with a plan for the future. All of that matters. Again, if you have been telling yourself, I'll never have enough, I want you to pause and replace that with a better question. What do I actually need? And what is the wisest path forward for me? Sometimes the problem is not the door that is closed. Sometimes it is that nobody explained to you how to open that door. I like that. It's not about the door that is closed, it's about understanding how to open it. And that is why I like videos like this, because this matters. This gives you information on how to open that door. Informed decisions leads to peace, and peace matters when you are making one of the biggest financial decisions of your life. If you enjoyed this video, watch my next video where I talk about whether or not new construction is worth it. Because that video, I will help you understand what buyers often miss beyond the mortgage payment when they're considering what to buy. So, see you there, and remember, God loves you, and so do I.